Today I would like to analyze Kraft Heinz, one of the largest food companies in the world and one of the worst performing stocks in the last 5 years. The stock price is down around 42%, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 30.28 billion US dollar. This makes Kraft Heinz the 18th largest food company in the world by the market cap. We also have a dividend yield of around 6.34%, which is very huge in my opinion. What we can see here in the last 10 years, the dividend actually decreased. So this is something we don't like to see. We're going to take a look at the financials to find out if they actually can afford to pay the dividend at the moment. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 26.19 billion US dollar. We had a good growth around 5% from 2019. In 2021, we had a decline around 0.55%. This is something we don't like to see. Then in 2022, we had a decent growth around 1.7%. In 2023, we had a small growth around 0.58%. And then in 2024, we had a decline around 3%. So overall, in the last 5 years, I think the revenue growth was not very good. So it wouldn't be a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 4.33 billion US dollar. This was a very good growth rate, around 55% from 2019, so probably related to COVID. Then in 2021, we saw the decent growth around 3%. In 2022, we saw the strong decline around 65%, but I think it's also understandable because in 2020, we saw the very good growth rate. Then in 2023, we had a very good growth rate again, around 90%. Then in 2024, we had a decent growth rate around 6.6%. So overall, I would say in the last 5 years, we had a good free cash flow growth, so it would be a check here, and we like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 3.16 billion. Then we're going to divide it with the current market cap. So the current market cap is around 30.28 billion. And then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 10.43%, which is a very high free cash flow yield. This is something we like to see, so it would be a check here. We can also take a look at the future assumptions of the free cash flow. We can see here in 2027, it could be around 3.66 billion. So let's assume around 3.6 billion for 2027. Then we're going to divide it with the current market cap, 30.28 billion. And then we're going to get a different free cash flow yield for 2027. So the number we're going to get would be around 11.88%, which is again very huge. It would also be a check here for 2027. This already could be an indication for undervaluation right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first you're going to take the long-term debt, 19.31 billion. Then we're going to add the short-term debt as well, 1.9 billion. And then we're going to divide it with the current free cash flow, 3.16 billion. Then we're going to get the debt to free cash flow ratio. So the number we're going to get would be around 6.71. And this number is not very good actually. It means in close to 7 years we can repay the debt with a free cash flow. So it's not a check here and we don't like to see that. We can also take a look at the cash on hand, how much money this company has in the bank, around 2.56 billion. I think that's a good amount actually, but overall I think this company not has a very good balance sheet at the moment. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. This can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first you're going to calculate the enterprise valuation. That's the current market cap, 30.28 billion. Then we're going to add the debt as well. So the debt is around 21.21 billion. Minus the cash, 2.56 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get would be around 48.93 billion. So now we're going to divide this number with the current free cash flow, 3.16 billion. And then we're going to get the ratio that we're looking for, and that's around 15.48. And I think it's a very good number. We would like to see that number under 25. So as a check here, we can also calculate this number for 2027 with our free cash flow assumptions of around 3.6 billion. Then we're going to get a different number. So the number we're going to get would be around 13.59. And that's also a very good number actually. So for me, this is already an indication for undervaluation. It would also be a check here for 2027, and we like to see that. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we're going to take a look, and we can see here in 2024 it decreased around 1.8%, and in 2025 around 1.5%. So I think these are good numbers. They buy back their own shares, and this can help the stock price to increase as well. But I also think they should be carefully, because at the moment they don't have the best balance sheet. But it still would be a check here for shares outstanding decrease. Can the Kraft Heinz stock be a good buy right now? The stock price is down around 42% in the last 5 years. So let's start with a positive about this company. I think they have a decent free cash flow growth in the last 5 years. I also think they have a very good free cash flow yield at the moment, around 10.48%. In 2027, with our free cash flow assumptions, it could be around 11.88%, which would look even better. The enterprise valuation to free cash flow ratio around 15.48 is also very good at the moment, and in 2027 with our free cash flow assumption, it could look even better around 13.59. So we want to see that number under 25, so I think it's already an indication for a fair valuation. We also have a dividend yield of around 6.34%, which is very high at the moment, and I also think they can afford to pay the dividend because they have a very high free cash flow yield. They also have shares buyback, so this means they buy back their own shares, which can help the stock price to increase as well, so we like to see that. What I don't like to see about this company is a bad revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. Also, the balance sheet is not looking very good. The debt amount is quite high at the moment. So overall, I think the valuation is very good, but I don't really like the business as well. I think this company has a lot of competition. So overall, I would not invest in this company at the moment. But if you believe in the business and if you believe in this company, I think the valuation is quite good. If you found this video helpful, don't forget to like and comment and subscribe for more content.